friends, welcome to our channel createURWealth. We have decided to come up with videos to help our viewers on the market in this times of uncertainty. Let us start first with the stats, as it's important to know how long the recession generally stays and what are its impact on the economy. The first recession is famously known as a Great Depression, which lasted for almost 4 years and had severe impacts on the world economies. And the last recession that most of you will be able to connect to is in 2008 and 9. Although this was precisely revolving around the US and the Europe, but India did witness job cuts in exports industry and IT. Since India has always been relying on domestic consumption, the growth that India was delivering was far better than what the world was going through. In fact, in 2007, we grew at 9.8%, and in 2008, we were growing at around 3%, which was again far better than what the IMF had predicted. So how is 2020 different from 2008? When our Finance Minister Nirmala Sitharaman amended the corporate tax structure last year, that was considered to be as a major steps in boosting the demand and investments, as the growth had slowed down to almost 5%. With this historic tax cut, India became on par with other Asian countries, starting to attract investments, as it would create more jobs directly in manufacturing industry and other existing major companies. So what went wrong? Well, it's the COVID-19. Since the month of Feb 2020, we have received several downgrades on our growth rate, and the worst is from the Moody's. And as per them, India's GDP can slide down to 2.5% from 5.3. As per FICCI, tourism, hospitality and aviation are the worst affected sectors that are facing maximum brunt in the present crisis. Closing of cinema halls, declining footfalls in shopping complexes has affected the retail sector by impacting consumption of both essential and mandatory items. Consumption is also getting impacted due to job losses and decline in income levels of people, particularly the daily wage earners, due to slowing activity in several sectors including retail, construction, entertainment and etc. With widespread fear and panic now increasing among people, overall confidence of consumers has dropped significantly, leading to delaying of their purchasing decisions. So is this the stock market actually reflecting the current state of our economy? Well, markets currently behaving based on the future course and the repercussions of COVID-19, which has made the stocks react with high price action. In a span of 12 weeks from the highs of 12,400 levels in Nifty, we have touched down to 7,500, which is almost 40% dive. However, we have now recovered slightly and trending around 9,000 levels. So is this a good time to invest? Those of you who have recently started following the stock market would not know how the market behaved in the last recession, that was in 2008 and 9. In early 2008, the market was trading around 6,200 levels and made a low of 2,200 in a span of 10 long months. However, in this downtrend, the market recovered several times and in fact gave returns of over 20% returns in a very short span. But again, let me remind you, it was very volatile. Hence, the risk calculation is a must. Here in the blue box, the market took almost 2 years to regain to 2008 levels. So if you're not a professional, then it is surely the best time to stay away from the market. But if you're an investor, then this is the best time to identify and look for the good fundamental long-term stocks. Here is the chart that shows average returns if you've picked up good fundamental stocks. So friends, this is all we have in this video, and soon we will come up with more informative ones. If you've liked this video, then do share it and like it and subscribe to our channel. Thank you so very much. Hello friends.